Welcome to the BC Property Agents podcast. My name's Bruno, and this is a solo show. No guests, no fluff, just practical investing strategies you can use to build a portfolio that gives you options. If you're an investor or you want to become one and you want to understand how to buy high quality investment properties with strong fundamentals, this series is for you. In season 1, we're covering how to choose suburbs, how to run the numbers properly, co-living and high yield strategies, new builds versus established homes, and how to avoid the traps that cost investors tens of thousands of dollars. Here's what you'll walk away with from this episode: a simple investor blueprint, a step-by-step decision framework, how to separate a good-looking deal from an actual good deal, the exact filters I use before I ever recommend a property to a client. Who is this podcast for? The podcast is for you if you want a portfolio that produces cash flow, a long-term upside, and don't have time to inspect 50 properties and second guess yourself, and you want a process, not random opinions. And just to be clear, this show is general information, not personal financial advice. Always speak to your accountant and finance team about your own situation. The problem with most property advice, most property content online, is entertainment. It's the suburb is going to boom. It's this strategy will make you rich. Buy this because I said so. But investors don't win with hype. Investors win with a process, because property is forgiving over decades, but brutal over the first 12 months or so. If you get the basics wrong, overpaying, buying in the wrong location, choosing a product with poor demand, underestimating holding costs, and having no buffer when rates or vacancy move. So today, let me give you the blueprint, the investor blueprint. I look at every deal through 5 lenses. If a property fails in any of these, we don't chase it. So number 1, it's the goal. First, what are we buying for? Is it growth, yield, or is it balance? Because the right property for one investor is the wrong property for another. A high income investor might want growth and negative gearing. A portfolio builder might want strong cash flow so they can buy again sooner. A risk-averse investor might want stable tenant demand above all else. So step 1 is clarity. What does success look like for you in 12 months or 10 years? The second one is the market. The suburb must have real demand, not just someone said that it's good. We look for fundamentals like genuine employment and economic drivers, population growth and household formation, tight vacancy trends and rental demand, infrastructure that supports livability, and sensibility and sensible supply, meaning not endless new stock coming online with no demand behind it. I'm not chasing one magic suburb. I'm looking for a repeatable pattern, demand that exists whether the headlines are good or bad. The third one is the asset. The property matters. The property type must match what the local market actually wants. The examples are, if the area is dominated by families, a tiny product with a weird layout can sit longer. If it's a renter-heavy area, a low-maintenance product can outperform. So we look at layout and functionality, what tenants actually search for, condition and maintenance risk, and any red flags like strata issues, poor build, quality, or awkward floor plans. The fourth are the numbers, the real cash flow, not the fantasy. The numbers must work in real life, not on a spreadsheet with best case scenarios. So we run it properly. Realistic rent based on comparables, realistic expenses, management, insurance, rates, maintenance, vacancy allowance, utilities if it's applicable, and we stress test the interest rates. My rule's simple. If a deal only works when everything goes perfectly, it's not a deal, that's a gamble. And the fifth one, the risk plan. What if things go wrong? Because life happens, rates change, tenants turnover, unexpected repairs, delays, market shifts. The best investors aren't the ones who avoid risk, they're the ones who plan for it. So we ask, what's your buffer? What's the vacancy plan? What's the property manager strategy? How liquid are you if something goes wrong? And we only proceed if the risk is manageable and the upside makes sense.